Welcome everybody to the latest edition of the Adviser Hour with me, Lawrence Gosling, brought to you by GrowthInvest. And we are broadcasting live from our studios in Westminster. And it's rather cold outside, but hey, it's winter and that's what you get. And today we're going to look at venture capital trusts and more importantly, how to grow your VCT business as an advisory practice. A little quick bit of a history lesson for everybody who wasn't around in November 1994 when the then Chancellor Ken Clarke announced the formation of venture capital trusts to bring more growth capital into the industry. And to extend the history lesson, they followed on from business expansion schemes. Yes, if you remember those, you're nearly as old as me. Anyway, forget about the history. Let's get on to the sort of here and now. So I'm joined by my panel. We're going to cover off all the elements. So first and foremost, Martin Cosgrove, the Chief Investment Officer of GrowthInvest. Good to see you again, Martin.
Good to see you, Lawrence.
And I know you've got some particularly kind of interesting views about the VCT market and how it's evolved in the last couple of years, which I think provides kind of quite a lot of opportunities for the advisor market, doesn't it?
Yeah, it definitely does. I think there's definitely a movement towards digitalisation, which I think is long overdue. And I think that's going to open up a lot of opportunities for advisors and their clients to access, a more diversified portfolio of VCTs and reduce the administrative burden. So
perfect. Well, we'll come on to that in a bit more time. Nick Britton from the Association of Investment Companies. Nick, you've been with us before on some of the other sort of programs, I think. And just for people who are not sort of familiar, I think the AIC is all about investment trusts. I mean, clearly venture capital trusts are companies, aren't they? Hence why you as an organisation kind of talk about them.
Yeah, venture capital trusts, like investment trusts, are listed vehicles and they have a similar structure to investment trusts, but obviously work in a different way when it comes to tax features.
Yeah.
So so we represent investment trusts and VCTs at the AIC.
Perfect. And I know you collect a lot of really useful data. Well, again, we'll get into some of that. Next we have Jason Warren from Northern Venture Managers, NVM. I always struggle with the three letters. We'll stick with Northern Venture Managers if you don't mind, Jason. So for people who are not too familiar with NVM, just sort of quick potted history.
Yeah, sure. So we've actually been around quite a long time as a firm. So we founded back in the 80s actually by our chairman Tim Levitt, who's still, as I'm sure many of you will have met him, he's still very, very involved in the business today. And we've launched as one of the first VCTs on the scenes in the mid-90s. Yeah. And we've been managing them since, really. So we've now got two bits to the MVM business. There's a private equity piece, and then there's the VCT business as well. And on the VCT side, we're investing that into kind of scale up early stage businesses. So
you're real growth managers, aren't you, in that sense?
Yeah, very much so. So it's all about kind of venture capital backing early stage businesses with a growth plan to kind of scale up and grow into very sizable organisations.
Good, and we'll dig into a bit more of that as we go through the programme. And last but not least, the person whose name I'm going to struggle with the most, I'm going to do my damnedest to get it right, Ava
Carlson.
Thank you very much for bailing me out on that one from Tilney Group. Yep. Now, you've been looking at the market for, actually we were talking off air for a good 20 years, actually.
Yep, close to that now, yeah.
So I think you're old enough to remember, and we've both got those grey beards, so we can prove it. Business expansion schemes. Right. So you've seen the market through its kind of evolution, haven't you?
Yeah, all the different styles of VCTs, different uses for VCTs as well in financial planning. And again, since 2015, we've seen again different uses of VCTs coming through in the financial planning world. So.
And let's get to the sort of first kind of sort of formal question. You sort of pick up on that. When as a firm, because Tilney does a lot in this sort of space, has done historically, how do you sort of balance up the kind of the risk and rewards to clients when you're sort of talking about them?
So the first thing we will do with clients is that we want VCTs to be part of a financial planning piece. And so what I mean with that is that we will sit down with the clients, look at their long-term goals, and we see where we can fit VCTs into that long-term goal, and whether that's a retirement planning piece, or whether it's a general financial planning piece, or on occasion we will play around with the taxation of the client to see where we can help alleviate some of the tax burden for our clients. So back to the old tax shelter model from that point of view, but otherwise it's part of long-term planning.
And Jason, I guess from NVM's perspective, when you're out talking to advisors, you're focusing on actually the investment potential, aren't you, as a sort of growth manager, sort of first and foremost?
Yeah, exactly. So we're talking about, the UK is a fantastic place to start and grow an early stage business, and that's very much kind of the trend I guess we're capitalising on. So as I said, we're focused on that scale-up stage to businesses that have found some product market fit, and now's the right time to kind of put growth capital into them to help them really scale up.
And Martin, from GrowthInvest's perspective, I think viewers have been sort of watching the programme. We've talked a lot about EIS over the last sort of kind of year or two, and that's obviously where the business sort of started. But you've kind of evolved as a business now, haven't you, to address a lot more of the VCT kind of issues for advisors?
Yeah, we have, Lawrence. When I started looking at VCTs, I was really surprised at how paper-driven and inefficient the market was. And just to put some context around that, if you wind back 12 to 24 months, to invest in a portfolio of 5 VCTs, it really required paper applications for each one. It required, individual checks going to each VCT provider, dividends being sent out by check to the underlying investors, and then ultimately you end up in most cases with a paper certificate which can get lost or filed away in a drawer. And as a result, there's been a pretty significant lack of visibility on reporting across a portfolio of VCTs. So I think that really sort of summarises what we're trying to fix at GrowthInvest. And we recently launched our new VCT service. And the idea behind that is pretty simple, focusing on 3 core areas. Firstly, provide advisors advisors a portal to go in, research, conduct due diligence, and ultimately invest in all live VCTs on the market. And that's really important to give, advisors the ability to conduct whole of market research. When you move on to the investment side, we've been working really hard with a number of the VCT providers to actually put in place digital applications, which we've been very surprised by the uptake, and we've made a lot of progress there, which is great. And then post investment, we've actually put in place a solution with Crest, which, for those who may not be aware, is a settlement system which really underpins most of the UK listed market. And the VCT providers have actually evolved to a place where in most cases they can allot those VCTs into Crest in a dematerialised format, which means ultimately you don't have any share certificates. Now, why is that good? Firstly, you don't lose paper share certificates. Secondly, dividends can be paid directly into Crest, and as a result, advisors like that because it funds ongoing platform fees and advisor fees and gives a yield onto the platform. And it really opens up that ability to be able to report on a live basis and granular basis around market prices, NAVs, and the such like. So we're really trying to solve it back to front and give a holistic solution for diversified VCT investing.
And Nick, some of the issues that sort of Martin kind of mentioned there that obviously GrowthInvest is addressing are things, in my experience, some advisors who are not used to VCTs don't realise, to your point, listed on London Stock Exchange, pay dividends in many cases very similar to a large blue chip equity. Where are the sources of information, call it education, but that can help advisors kind of understand some of these issues that they're not familiar, or if they have specific questions? I'm guessing the AIC's got a good load of it.
We have. I mean, one of the things we do is education. We go out and talk to a lot of advisors. We run events. We take part in other people's events. Yeah. We have VCT data and statistics on our website, and all that we provide is free of charge. Now, in the sort of paid-for space, there's a lot more available than there used to be as well. We've heard about some of the services that are offered by GrowthInvest, and I think making it easier to the whole process of investing in VCTs, making that easier and more painless is really, really important. There's also various third-party research sources. So you've got Allen Bridge, Tax Efficient Review, been around for ages. You've got MyCap, Intelligent Partnership. And all those offer a certain amount for free, but you'll have to pay to get the full service. And depending on how much VCT business you do, if you're doing quite a bit, actually that could be worth looking at. Because VCTs are very specialist investments, and understanding what's driving performance or returns at a VCT can take some quite in-depth research into what the management team is doing, how they operate. So sources of information and education, I would say, are much more plentiful than they were, and it's just a case of getting out there and finding them, using them.
And Jason, from your perspective, what are the sort of common questions you're asked by advisors who, again, perhaps they're meeting your firm for the first time, but also are just perhaps not so familiar with the sector, and they're sort of, they're kind of edging into it sort of slowly because obviously clearly they don't want to expose any clients to risk? Yeah,
so I think one of the common questions we get is, is around the profile of company we're backing and perhaps how we differentiate from some of the other VCTs as well. So at MVM, one of the things we do is we invest a lot in the regions. So we have investment offices in Newcastle, Manchester, Birmingham, Reading, and there's a team of us in London as well. So with that, we're able to invest, across different areas. And I think it's understanding, as well as kind of the general VCT picture and what a VCT can offer their clients. It's understanding what each specific VCT kind of focuses on and where their specialism is. So we get a mixture of those two types of questions, I think.
And does that feed through to the issue of kind of suitability, them sort of making sure the advisor is recommending to his or her client the sort of a suitable?
Yeah, exactly. So it's about understanding the profile of companies we back, for example. So with the rule change, we're typically backing early stage companies that are often sacrificing profitability for growth. As you would expect in venture, and I think, there's certainly there's that piece to explain to clients and make sure that's suitable for them, and the risk profile attached to those investments is right for them.
And I'll get Nick to talk about the rule change in a minute, but Ava, just go back to the sort of the basic nuts and bolts, so tax breaks, those kind of things associated with VCTs, because I just realised we're 10 minutes into the programme. I've not asked them, because we're all familiar with it. I've assumed everybody is, which is a fault on my part.
No, it's a good question, because I think it's important people realise it is a commitment, a minimum commitment of five years that you do when you invest in VCTs, so you do need to be aware of that. If you do sell within 5 years, there could be some tax consequences for that. It could be that you can't get the money back that you put in. It could have been that the value's gone down a little bit over time, but often the VCTs will trade at a discount to their net asset value.
So this is very similar to investment trust, which Absolutely. People are very familiar with.
And that can be anywhere between 5% and I've seen sometimes 20% and sometimes even a little bit more. So you do need to know that you are restricted really on the liquidity there. Also, there's no secondary market as such. It is possible sometimes for VCTs to buy back their shares, but sometimes there could be a few months in between when you put it up for sale and somebody buys them. So keep that in mind. For the tax reliefs, it is the 30% income tax relief. That's the main thing most people will go for when they look at a VCT. And obviously there's also then the dividends that are tax-free, which is really important, which is why we tend to see VCTs these days at least, often used with retirement planning. Yeah. Because of the potential for regular dividends. Which becomes interesting. Also, there's no capital gains tax to pay when you come to sell the VCT, provided obviously that it's gone up in value.
And the tax-free dividends, that means as a private investor, that's over and above my annual allowance on dividends as well, isn't it?
So in fact, you don't have to even report on it, which is the great thing about this. One less thing to file.
Yeah, one less thing to talk to the HMRC about is always good news for everybody.
So that's good. Super. Now, you are restricted to £200,000 a year, and that's good to remember that. Some advisors will also be using EIS, and obviously there you can put much more into the investment. The VCT is £200,000 a year, and that also applies to when you are gifting VCTs to maybe your children. And you can't really gift more than £200,000 in any 1 year, because the recipient can't be doing that. There's some tax consequences if you invest more than £200,000 a year, in that you'll have to start paying tax on the dividends of the excess, similar to, I guess, what people are used to with pensions.
Excellent. Lovely, that's a great synopsis. Now, Nick, let's just sort of talk about the kind of rule changes sort of back in sort of 2017. So I think the backdrop is people even will be aware of the patient capital review. Yes. Nothing to do with Neil Woodford. This is, this is a government review about the way that the sector is getting capital coming into it. It tweaked the rules a little bit for VCTs to sort of get back to the true, I think, spirit of sort of tax efficient investing. Would that be a right way of explaining?
Yeah, I think that's fair. I think VCTs were supposed to be about investing in fairly early stage young companies that couldn't raise finance in other ways, and that's why you get the tax relief, to stimulate that kind of investment. The 2017 rule changes did three main things I think you have to worry about or think about. One of them is the risk to capital condition. So it said if a VCT is making an investment, there has to be a genuine risk to the investor's capital. Now you might think, well, there's bound to be a risk to capital. You're investing in young early stage companies, but this was just it's a principles based rule rather than nitty gritty. That there has to be that risk there. The other one is around debt. VCTs can invest in companies' debt. In other words, they can lend money to companies, and they can still do that. And it's quite a big advantage of VCTs actually over EIS, which can only invest in equity. But VCTs were restricted in the way they can invest in debt to investing in unsecured debt. So that's just another thing to kind of push them away from doing lower risk investments. And the third thing was that VCTs were told when they raise money from investors, they have to invest it quicker. So they have to invest 30% of it within 12 months and 80% within 3 years, whereas before it was 70% within 3 years. So what that adds up to really is pushing VCTs a bit more into investing in higher risk, what people would really think of as higher risk, earlier stage companies. And at the same time, by encouraging them to invest their money faster, it means VCTs probably, and Jason would confirm, might be more conservative about how much money they choose to raise in a particular fundraising. And that means from the advisor's perspective that if you want the biggest choice of VCT offers, you need to be aware of this throughout the tax year, not just in March. And you might sometimes need to act quickly because these offers can fill very fast.
And Martin, what this done is we've seen more sort of growthy orientated sort of vehicles in the last sort of 18 months or so, as opposed to the kind of what you typically describe as asset backed. There seemed to be quite a lot of schemes prior to that had a sort of a property base, a big asset sort of, and that was to generate the income. So to kind of Nick's point, the government sort of moved things on, so there's more capital at risk involved, and that's created some new opportunities for advisors.
Yeah, it definitely has. As you quite rightly say, you have VCTs out there who have a legacy asset-backed portfolio, and clearly the rules now are about venture-based investing. So, what we're seeing as a result of that is, whereby you may have an advisor and underlying client who may have just invested their entire investment into one asset-backed VCT. Really, what we've seen is that's driven the need for diversification, and more so we're seeing, our advisor clients, looking at the VCT service as really a way of diversifying. For a £100,000 ticket, maybe investing in 5 VCTs or 4 VCTs.
And Jason, I guess from NVM's perspective, it actually didn't really change very much, did it, from the way you were managing your sort of vehicles anyway?
Yeah, so we were, prior to the rule change, we were still kind of backing small businesses throughout the UK and across the regions. So we were doing them typically around management buyout transactions before the rule change. So perhaps slightly later stage companies. So with the rule change, we were affected in the sense we did move up the risk curve, I guess, and into kind of the early stage businesses. And, we built a team around that style of investing now, which I am one. That was kind of my entry into the space, and we've tried to build that team to kind of reflect that type of investing. So we've brought in a mixture of people from different backgrounds. So myself, I was a software engineer, so I had a previous career kind of developing code for Morgan Stanley and a hedge fund, and then kind of came over. And we've kind of tried to mirror that as we've built that team of a mixture of people from kind of technical and different commercial backgrounds to kind of reflect the fact that actually we're now backing kind of earlier stage companies where perhaps they welcome greater input and they're across a broader range of sectors as well. So we were affected by the change, but we've kind of been reacting to it and building this team and operation over the last few years.
And Ava, just sort of quickly before we go to our kind of ad break, from Tilney's perspective, as you looked at the market, how has this kind of rule change kind of affected the kind of schemes in general that you've looked at as a firm?
So we've seen obviously the likes of NVM that have pivoted from MBO focus to earlier stage, and we've seen that with a host of other VSTs. But interestingly, and thankfully also, excitingly even, we see new VSTs enter the market. So that's been a really good innovation, I guess, in this space. New blood, very important. Some specialist providers, so focused on maybe on particular sectors. You've got some consumer focus now. We've got another new VCTs coming in, brand new from maybe from an EIS background that have gone into this market. We've seen some interest from what I would say PLC investment companies coming into this market now with the VCT, or even purchasing VCTs now to get a foothold. So there's lots of things happening now.
Good. Thank you very much for that. Now we'll dig into more about the research and the mechanics that you do as advisors to get, to Martin's point, get genuine diversification, and then we will pick up on the sort of thorny issue of fees and charges, which clearly is it's kind of very important to everybody involved in the chain. So stick with us. We're going to have a little ad break just to give my panel a chance to have a slurp of water because it's warm in here, and we'll be back in a couple of minutes. Alexander, good to see you. Let's sort of start at the beginning. What originally interested Calculus in investing in Synpronics?
Well, Synpronics was an early stage company with an exciting technology in the gene therapy market, which is was and is a growing and an exciting market in its own right. In addition, Synpronics had an excellent management team. They had a CEO who had experience, had done it, seen things go well and wrong, and knew how to progress the company forward. They had a CSO with extremely good science, and they had a spectacular relationship between the CEO and CSO and founder, because they respected what each other could do and could build on that to build a business.
So given that sort of quality of management that you were attracted to, what was the other sort of additional support other than the money that you were able to provide to the business to help it sort of grow?
We look to work with our companies from the day we invest. We look to help them build their strategy towards an exit that we and they want. We look to support the management team, and we look to find the right board to build and strengthen that business. And then, as we come towards the end of our hold period, we work with them to get the deal structure that is right for the company and for the investors.
So that's the sort of mentoring, the physical money you put into the business. What did it allow Synpronics to do?
So Synpronics was a small company, about 15, 20 people. It was based in various disparate offices. The money allowed them to build that team. It went up to nearly 40 people by the time we exited. It allowed them to come together in new premises close to where Dolly the sheep was bred. It allowed them to invest in R&D that created a product that became truly exciting to potential acquirers and investors going forward.
So, Alexander, as I've touched on a couple of times already, you've now exited from Synpronics. Tell me more about the deal.
Well, Calculus is a very experienced exit-driven investor. The Synpronics exit is our 39th under our current investment strategy. When we're going into an investment, we look at exit opportunities from day one. Once we've invested, as we're going through the process, we build a company strategy with the management team to focus towards an exit.
And as you said, this is the 39th exit for Calculus investors under the current investment strategy. What are the benefits that they've got out of this particular exit for you?
Well, the acquirer in this case was very clear that they wanted terms to remain confidential, but the exit was significantly above our target returns. And we're very pleased to have delivered those numbers to our investors in less than a 4-year period.
And given the success of this deal, are you going to be looking at more opportunities in the sort of biotech space?
We will definitely look at the biotech space. We have before, and we will again.
Welcome back, everybody. Goodness me, I keep stumbling at the beginning of these sentences. Anyway, good to see you back. Thank you for sticking with us. So we talked about really the backdrop to the VCT market, a bit of the history, a bit of how the rule changes have helped the market evolve, and some of the new services that GrowthInvest are offering to make hopefully life easier for you as advisors. Let's move on to really how you do your research as an advisor. How do you get real diversification and look at the space, and what do you look for on the sort of fee side of things? Because ultimately the performance is one thing, but if there's a big fee drag, then you ain't going to have a happy client, and we all want happy clients. So Ava, just sort of pick up. You started talking about, just before the break, this sort of evolution. Broadly, there are kind of 3 types of VCT, I think, would be a way of looking at it.
Absolutely, and one in the middle, in fact.
Yes.
So you've got the generalist, that's the bulk of the VCTs in the market.
Yeah.
You've got some specialist AIM managers. Often you'll find actually that they're probably more generalist in their approach than the generalist VCTs, because they obviously have a wider market almost to invest in. I say wider market, but specifically on AIM.
Yeah.
Then you've got a couple of VCTs that focus on basically do 50-50 generalist and AIM.
Yeah.
So keep in mind that some of those VCTs may be a little bit more liquid than the generalist VCTs. And then you've got the specialists. and they can specialize, and maybe people remember some VCTs specialized in the renewable sector. No longer possible, clearly, with the asset rules, but there's other specialists, technology focused, could be consumer focused. But the very specialist niche operators. And so when you are putting a portfolio together, you could have a look at some generalist, maybe a couple of hybrids, some AIM, and maybe a couple of specialists. And if you spread that out over several years, especially for people that are doing this for retirement planning, you can build up a really interesting portfolio of investments.
And Jason, NVM, you would describe yourself as specialists or not?
So we're actually generalists in terms of sectors. So we invest across a range of different sectors. So I'd probably put us in that generalist bucket, I guess. We do still have a small listed portfolio, and actually the portfolio today is a mixture of the kind of the MBO assets and the early stage assets. But obviously over time that will transition to being kind of early stage assets, but across multiple different sectors and verticals. So technology and software, but then also some med tech, some kind of food and drink businesses, and some other sectors as well. So we are quite broad in terms of industry, but we focus on that kind of scale up stage, I guess. That's where our sort of specialism is.
And Nick, I guess this is one of the challenges for advisors, because although they're all called VCTs, as Ava quite rightly says, even putting them in sort of three buckets is not the most satisfactory way of kind of analysing things. In terms of when you're collecting data at the AIC, do you break VCTs down into certain sort of industry type sectors? How do you analyse the data?
Well, our sectors pretty much follow what's already been laid out. So we've got the generalist sector, which is the bulk of VCTs, certainly by number or assets. The vast majority are in that. Then AIM, I think we've got about 10 AIM VCTs, and then the sector specialists, so environmental, technology, media, whatever. But that's as much as we break it down. Obviously, you've got to dive into the generalist sector to understand the differences between one manager and another, because there are important differences to bear in mind. And it goes back to that point of thinking about VCTs as investments, not just as a tax tool, and actually understanding the manager's approach and what they're looking for.
And what about the issue of sort of discount to NAV, sort of Ava touched on it sort of earlier. I mean, that's one of the standard sort of measures that you have in the AIC data tables, isn't it?
Yeah, discount is very standard for investment trusts, very important. For VCTs, it is important, but because the shares aren't normally traded on the secondary market, as has been already said, your exit is likely to be using a VCT manager's own buyback scheme. So it's almost as important, if not more, to look at the terms of that buyback scheme than it is to look at the market discount at any particular point in time. Now, that buyback scheme is not guaranteed to buy back shares, but in the past, investors, advisors have normally been able to sell shares back to the manager.
And that's normally after a 5 or a 7 year period. There's normally a time span on it, isn't it?
Well, the 5 years is to just ensure that you get the full set of tax reliefs, and after that you are free to dispose of the shares and still get the tax reliefs. Obviously, the nature of the underlying investments means that a 5-year time horizon may, in some cases, not really be long enough for some of those companies to really come to fruition. So depending on the kind of VCT you're investing in, whether it's established or a new VCT, it may actually be beneficial to think of it on an even longer time horizon than that, but 5 years minimum.
And Martin, when you kind of look at the assets that are on the GrowthInvest platform, how diversified are they? Or clearly your service is just started, so you're sort of new to this, but in your experience of talking to advisors, are they generally quite well diversified, or is there traditionally people sort of go with one manager and then tend to follow that manager through a series of sort of tax years for clients?
I think it's a mix dependent on advisors. I think some advisors, as I touched on before, have historically had fairly small panels in large names, predominantly asset backed. But as I said, I think we're definitely seeing a movement towards diversification, and what we've seen a lot of interest on, on the back of the service we've launched is clients coming to us. Advisors coming to us with clients' underlying historical portfolios, and I've done a lot of work on those historical portfolios, and they tend to be pretty diversified, where they've been advised over multiple years and have made multiple investments over multiple years. the reason for the interest in that historical service as well is around the secondary liquidity. So we touched around discount to NAV, but it's super important because the liquidity is really from the buybacks from the underlying VCT providers. So and what you want to be able to do is actually get those VCTs into a form that are easily tradable. So we've done a lot of analysis of VCT portfolios. Those have been dematerialised into Crest, and then advisors have been advising clients to, in some cases, sell into the buyback. That money comes back onto platform, and then you can reinvest that into VCTs in order to gain added income tax benefit. So I definitely think that's a theme we're going to continue to see.
And Jason, do you, when you're out again talking, how do you try and differentiate NVM, your VCTs from others that are out there in the sort of market? Because again, people are not familiar will sort of go, well, it's a generous VCT, and that means they will kind of do the same thing. But clearly, you have areas of expertise.
It's a very good question, and I think I probably mentioned it a couple of times already today. But this regional piece and the fact we have these kind of regional investment offices, and we're building a portfolio that's geographically diversified as well as kind of sector diversified.
And what is the importance of geographic sort of diversification within a portfolio that's clearly UK-based businesses, even if their client base is not UK-based?
I think London itself is, there's lots of very good businesses in London, but it's also quite a competitive area from a sort of funding perspective. There's a lot of VC houses are based in London, whereas perhaps as you get into the regions, there's less funding and there's more kind of opportunity for value and things. And actually I think there's some nice charts and data you can see about there's a bit of a disparity between where the bulk of funding goes and actually the distribution of businesses across the UK. So there's lots of very very admirable businesses in the regions that aren't getting the funding they need. So there's lots of opportunity there, I guess, as well as because there's a bit less competition.
Probably benefiting from cheaper office space as well.
Yeah, exactly. So that's a good point. To be fair, you can find some quite good talent pools outside of London, so particularly Manchester and Bristol and areas like that, and actually the salary costs and therefore the kind of capital costs to build a business, especially when you're still loss making, are lower, and that can lead to quite an attractive dynamic as well.
And it's often said there's a great pool of talent associated with other universities that are not based in London or Oxford or Cambridge. Again, is that your experience?
Yeah, that's right. Yeah, so we've seen a few businesses that, like you say, we've got a business called New Cells up in the northeast with some IP that came out of one of the universities there. So there's lots of really interesting stuff going on outside of London, I guess, is the message. So we still do back some businesses in London too, but I think having that regional presence does differentiate us. I think the other pieces as well, we have been on the scene quite a long time. So like I say, we launched one of the first VCTs in the mid-90s. Tim, who founded MVM and launched that VCT, is still our chair today. So a consequence of those two things is we do have a very loyal shareholder base that we've kind of taken with us on the journey as the VCTs have evolved over the years. And we've been able to pay quite a good, consistent dividend yield over the years, which helps as well.
And Ava, how, to Jason's sort of point, when you're looking at the VCTs out there, how important is the time the firm's been around? Or we talk about track record in open-ended or traditional investment trusts. It's taken as a read. It appears to me to be kind of slightly harder to figure that out sometimes with VCTs.
I think especially now that the rules have changed, want to make sure that not only do the teams have experience in the sector that they want to operate in, which is why it's also interesting to see newcomers, or relative newcomers in the VCT space, but with relevant track record in the same space outside of the VCT market coming in. Within the VCT teams like NVM and a couple of other, stalwarts of the industry, we look at specifically at the makeup of that team. So do you have individuals that understand VCT rules? Have they been able to change in the past? Because rules have changed quite dramatically since the beginning. So have they been able to do that? And have they been able to attract really, the new style investment managers with different type of experience that can then plug into this new rule-based investing? So we're looking specifically at the teams, their ability to do this. And like you said, being a regional player makes a big difference on deal flow and the quality of deal flow as well. So that's important.
So, and Nick, you've got this data going back, haven't you, on the AIC database all the way back to whenever these trusts initially sort of floated. So, again, as an advisor, perhaps new to the space, I can do some fairly sort of standard looking at long-term 5, 10, 15-year type track record stuff.
The thing to remember is VCTs are listed companies. So to that extent, they are as transparent as any other listed company when you're looking at things like share price returns. We would encourage people also to look at NAV returns, because we've already said, discounts move around a bit. Actually, the NAV returns show you the returns of the underlying portfolios. It's what a VCT manager would often quote if they want to demonstrate their track record, and that's important to look at as well. But the transparency of information compared to venture capital investing in general, or private equity, or hedge funds, I would say is a lot better.
And that's because they are public companies?
Because they're public companies, yeah.
Sorry, I would add to that, when you are looking at performance, I would also be looking at the total return of the VCTs, not just the net asset value or not just the dividends on their own, but look at that combination. And is the manager able over the long term to increase the value on a total return basis?
Definitely.
And Martin, you were agreeing with that. I mean, it's...
Yeah, I mean, exactly in line with that. I think it's absolutely critical to look at NAV returns in conjunction with dividend returns, and that's always been the historical challenge of reporting on these assets, because dividends have been sent to individual investors in checks. Yes, dividends are publicly available around through a number of data sources, but to really look at the total return, you want to be looking at the NAV return or the price return plus dividends in order to really understand the the yield that the VCT is providing.
Yeah, I mean, on our website, we do show NAV total return, which reinvests the dividends over time, along with the growth in the NAV.
And Nick, in your experience, is the dividend profile of VCTs as consistent, as steady as, say, a blue chip equity, which will traditionally, knock out a dividend of 5 or 6p per share, once or twice or 4 times a year? How, in your experience, does it work with VCTs? Is it as consistent as that, or does it tend to be lumpy depending on exits, for example?
Well, some VCTs have absolutely been as consistent as that, extremely consistent dividend records over time. Now, we have to bear in mind the rules have changed. We'll see how that continues. Other VCTs have not aimed so much for consistency. So sometimes, if they've always been investing in early stage companies, they get one particularly good exit, they pay out a big special dividend. So it depends on the VCT, but many VCTs have emphasised a target level of dividend and trying to maintain that or grow it consistently over time.
I think your point on the factoring in the rule change is a good one, though, because what you'll see historically is actually, as the VCTs are able to invest in kind of a broader range of assets, they were probably doing more leverage and more loans, and that there's an income stream that came with that. Whereas as they're now shifting into earlier stage assets, where actually they're typically predominantly equity investments, so what that kind of creates is a slightly lumpier dividend profile.
And do you think that's where advisors need to really bear in mind with their client, the sort of the minimum 5-year sort of holding period? Because again, to your point, some of the early stage businesses, 5 years is actually a very short time in an early stage business.
Right. You should really remember these are patient capital investments. So we're probably going into most deals probably thinking about a 7-year hold period, because your point on liquidity earlier, actually, they're private investments, they're liquid investments, and it's all about kind of building capital gains in the company, really. And that, when it's an early stage business, that does take time, and especially to kind of get the maximum value, it does take time to kind of see that through.
And Ava, you going back a little bit to this sort of the 3 or 4 types of VCT. Sort of firstly, as a firm, how do you look at the generalist ones? Because there are themes. NVM, have got themes that sort of Jaysons touched on. Others are, they've got thematic, or they may be just a portfolio of 10 different businesses. How do you kind of analyse them as a firm, and then sort of explain that to sort of kind of clients?
Yeah, so we do cut the market in half almost. Well, maybe not half as such, but we do cut the market a little bit, where we will try to focus on the VCTs where we can see a track record. We try to focus then on the VCTs that are diversified within that portfolio. Because of diversification is so important, not just on diversifying between the managers, There's a huge difference clearly between a VCT that's starting out with 5 companies and a VCT that may have 70 companies in their portfolio. So we tend to go for the VCTs with a more established track record, a more diversified portfolio. We also look at the what they do with the non-qualifying element of the VCT. Does that create value, that non-qualifying, to pay for fees, for example, within the VCT, or is it just held as cash?
So could you just explain a bit the non-qualifying bit more for advisors who are not fully familiar with the VCT rules?
And so there the rules have also changed. So previously VCTs could pretty much do anything they like with that non-qualifying bit. Now, what we talked about before, in the 80% qualifying ratio for the VCTs now, used to be 70, so 20% really, just a rough figure you can do other things with. But you're so restricted now in what you can invest in. So, for example, you can do some other listed funds, liquid funds, daily liquidity funds. But a lot of VCTs have gone in for the more cash-like, really liquid. And so the returns on cash are really low, which means that you not only get a cash drag from when they've raised the funds, and they can invest it over the 3 years, we talked about that, but there could be a cash drag just from the cash that doesn't really do anything. So that's important to keep an eye on.
It's an area advisors must look at. So again, the client, to my earlier point, the client doesn't get a slightly confused sort of outcome at certain points because they haven't realised the way some of this works. Okay, interesting. Let's talk a little bit about issue of fees. Sort of, Nick, you kind of get to look across the market. Is the fee structure, does it look more transparent, more consistent perhaps now than it did a few years ago?
Yeah, I think it's always been pretty transparent. I think there's complexity there, and there are fees that you wouldn't necessarily see on investment trusts, for example. So there's the initial charge, sort of tends to be in the region of 3 to 5%, which covers the cost of marketing and promoting the VCT offer. So that's not borne by existing VCT investors. That's often discounted with early bird offers or loyalty discounts and such. So keep an eye out for those. You've then got annual management charges of typically 2 to 3%, other admin charges between 0.5% to 1%, and you've got performance fees above an agreed hurdle, which tend to be 15 to 20%. Not all VCTs charge them, but a lot of VCTs do. So those are the main kind of fees you have to be aware of. Obviously, running VCTs is a more labour-intensive business than running a quoted equity fund. You need quite a lot of skilled people. They get hands-on with the investments, quite often take seats on the board, constantly monitor them, and that takes resource and that takes time. And one of the reasons that VCTs and EIS attract tax reliefs is actually to incentivise that kind of investment. So yeah, fees are higher than with typical quoted equity funds. But on the other hand, that's no reason that people shouldn't still look at them, think about them, and compare one VCT and another.
Okay.
And we're getting quite a few requests on illustrations of fees and charges. So an advisor's looking at 5 VCTs and looking for a summary of, if I invest £25,000 into each, what does the like-for-like comparison look like for fees and charges on investment? So.
And how do you take that a bit sort of further, Martin? Because we can, let's say we're all clever enough to be running a VCT. Well, you probably are. You definitely are. I'm not sure I could, but we all had a generalist one. The calculations are going to come out sort of different. We're used to a passive world where you go, well, I'll just buy the cheapest because it's following the same index. Is there a more sort of nuanced way of kind of looking at the impact of fees? Presumably you've got to look at what the underlying manager is delivering to you in terms of potential returns or exposure to a certain sector, for example.
Yeah, I mean, look, I think fees is one consideration, and if an advisor has a view that he's dealing with two excellent VCT providers that provide a similar offering, then I think fees are going to obviously be compared, but I think there's a number of other factors we've discussed here, which fees are just one element, I would say.
And I guess, Jason, I mean, the point is you're all active managers, aren't you? You pay for what you get. We
take a board seat on pretty much every deal we do, and aside from the investment team we have that do that and work with these companies, we're building out a platform team as well that kind of support them in different specialisms. So, for example, we recruited a head of talent who will work with these companies, and often alongside our investment, perhaps for some of them it's the first time they've had an institution on board, and they're their own board kind of needs to go through an evolution. They might bring on a non-executive chairman or non-executive director. So our head of talent, we'll kind of get out there and find good people for the portfolio that can go and do these roles. And that's a team, we're going to evolve over time to support these early stage businesses. Again, reflecting the fact that they are earlier stage. They do need help in these areas, and part of the fees is to cover putting that support network around them really to help them grow.
And Nick, just to be clear, so VCTs have an independent board in the same way that an investment trust does. That's correct?
That's correct, yes.
And in your experience, how active have the boards sort of been? I mean, we've seen quite a lot in the last sort of 5 years on traditional investment trusts, in terms of the role of the boards that become more independent, more active. Have we seen that yet so far in VCTs, in your experience?
I think what we're seeing in the mainstream investment trust world is quite a lot of downward pressure on fees that we've also seen across the whole investment industry. I think that's been seen to a lesser extent in the VCT world, to be honest. I mean, they are providing more specialist investments, and there is a limited number of VCT managers. I mean, the industry's been around for 25 years, and it's although there are one or two new entrants, it's pretty much a group of managers who've been around for a long time, and I think for those reasons, perhaps the boards there hasn't quite been the same sort of action on fees, but in other areas, obviously, that the boards play an important role in just monitoring the risks that are faced by the VCTs, and sort of adding their own kind of input and guidance to the managers.
No, but how does Tilney look at the issue of sort of fees in this sector?
Well, in addition to look at the headline fees that are obviously all displayed in prospectuses and in the annual reports, we also look at not just the fees that you would charge individual companies in the portfolio, but we want to see what the VCT managers do in return for those fees. So value for money, really. And so if we were to see VCT managers charge fees but not really provide any services, we would question that with the VCT manager.
Any other fees that you look at and go, oh, that's a bit painful, it shouldn't really be happening? Sort of valuation fees, for example, on underlying portfolio.
Well, so it's interesting. There's one or two VCTs that don't charge arrangement fees anymore, possibly in line with where private equity is moving towards. So fewer fees up front, and a focus on the return on equity afterwards, so the carry, I guess. But that's only limited to a handful of VCTs where they don't charge those arrangement fees. And we've seen some VCTs in the AIM space now drop their performance fees. But that may have been on the back of a sort of a buoyant market the last few years.
I'm just going to say, AIM perhaps has not performed quite as well this year as it has in previous years.
It's picking up again, so that's good. But it's more of a focus on what are the extra services that the VCT manager can provide for those younger companies, and so are those fees justified?
Okay, lovely. Martin, leave the final thought to you. I'm an advisor. I've never got involved in VCTs before. Seen the programme. Fantastically inspired by the four of you. What do I do? Why should I get involved? Where's the opportunity for my clients, do you think?
I think it's a pretty mature space. I think there's some excellent VCT providers out there that are long established, that have proven that they can deliver yield and great returns. For the right client, the right sophistication and what you're trying to solve for, I think there is an excellent opportunity to invest in a diversified portfolio, get some great tax breaks, as long as you're aware that they're long-term investments and.
Okay, long-term investments, a good way to finish. Thank you very much to my panel. So if you haven't been involved in VCTs, hey, where have you been for the last 25 years? There's been a lot going on, but more importantly, the sector is evolving in really quite an exciting way. I am old enough to remember when they were launched. So hopefully today gave you some sort of an ideas and kind of where to take your first steps. If you've been using a few of them with clients, you've got a bit more information, what to look out for on fees, where the educational sources are, how to differentiate between some of the managers. There are a lot of generalist managers, but not all generalist managers are the same. So that's today's programme. If you stuck with us for an hour, and I can't believe you didn't, this qualifies for unstructured CPD, so just email us at growthinvest.com. That's the website. you can get hold of us, you know where we are, and we'll send you out the VCT certificate. And we look forward to seeing you again or joining us on one of our future programmes, and we're going to do a similar programme about enterprise investment schemes. From me and the panel, goodbye.